So today I will tell you about the crucial metrics for business to grow. So what metrics are crucial to count today, to count your dividends in the future? What numbers are the most important for your business? Because when you're doing business, you have a lot of hassles in different sphere, in all sphere. And when you come to finance, usually it makes a lot of stress of you because there are so many numbers, so many different tables, P&L, cash flow, balance sheet, etc. So that when I'm speaking with many people who are great business owners, but all of them hate finances because they say, so I don't understand what is the most important for my business. So we will try during the next half an hour to cover the most crucial metrics to make your finance less stressful for you. Okay, so first of all, just to add some credits to my words, I will tell about the company which I'm represented and about myself. So the John Galt Finance Company, basically what we're doing, we're CFO on demand or finance department on demand. We are coming to company, we are taking all the data that we have, we recalculating P&L, balance sheet, cash flow, not for the bookkeeping needs, not for the state revenue service, but for the management decisions. Our main purpose is to make finance work for business. We have to make decision for business owners based on the numbers. We're trying to find some potential points to grow, some potential risks to avoid, and together with founders, together with different stakeholders, we are helping business to grow. Regarding myself, I have more than 10 years experience, so basically 12 years experience in finance, starting from junior finance analyst, and during 5 years, I believe, I was working CFO as startups, as in big real estate funds, not only in the Baltic state, but worldwide. So we'll try to share my experience in finance with you. Okay. So many startups and in general small businesses and even large businesses are living in the paradigm, fake it until you make it. And this is good, this is okay. You need to fake, you need to kind of oversell your reality to different stakeholders, to investors, to, I don't know, some partners, even to some employees, because everyone wants to invest or wants to work in company, large company, growing company. So that's why, yes, you can kind of sell a little bit better reality than it is. But if you want to grow, if you want to kind of make right decisions, you need to avoid lying to yourself. Yes, you can say that you have huge MRR, huge valuation, and huge market share, but you need to understand what you have in reality. Because if you want to grow, you want to understand where you are now and what are your reality, what you really want to scale. And so some weeks ago, I was visiting several conferences, especially for startups, for example, Textual in Riga and some else. And I have heard the same information from many startup guys. So they're telling the same information, and many of them, even themselves, they don't understand this information is not true. First of all, the main metric among many businesses is annual recurring revenue, ARR. And people are telling that they have huge ARR, but they count it differently because ARR is annual recurring revenue. So it means that it is recurring revenue. So it means that revenue from the customers who are on the subscription, who kind of pay not once, but kind of on a monthly or an annual basis during the last 12 months. But usually, startup guys that just multiply their last months, not even recurring, but just revenue, including all the one-time bills by 12, and pretend that this is the annual revenue. You're kind of fundraising at each investment, but you need to understand for yourself what is your annual recurring revenue, because when you want to grow, you need to grow the real metric, not the imaginary metric of 12 last months MRR. And the second, because when you're planning, so you need to understand, okay, why it is crucial, because when I plan my future budget, I need to understand what real number of money I will receive. If I just multiply last month by 12, and last month includes a lot of, I don't know, discounted sales or some one-time sales, there is probabilities that I will not achieve this target, and it makes risk for myself because I can have cashback for business. The second really important metric is valuation, and especially for pre-seed and seed startup or any early stage business, the valuation is there is no one well-defined method how to count valuation. Because, for example, when we are speaking about mature company, there are discounted future cash flow, or I don't know, gross Gordon model or something smart finance stuff. But when we are speaking about small startups, there are like well estimated guess. And usually we can see in some database that in the same months, two startups for the same region in the same sphere with kind of similar metrics, they have absolutely different valuation. One can value it by 1 million and one can have valuation of 10 million plus. Because the valuation of startup in the initial stage is only how founder can sell it. And there are two types of valuation. One is desired valuation. For example, I can say I want my startup is valued 5 million. Nobody wants to buy it, this share, or nobody wants to invest in my startup this valuation, but I believe we have this valuation. And this is kind of okay, this is my personal valuation. I believe in it, but it doesn't have any relation to the reality. The second point is that we have proved valuation. If somebody invested in my startup with my desired valuation, it means that I already can pretend that this valuation is kind of correct because there are some people who invested in with this valuation, and this is kind of more credible, 1,000 times more credible than just desired valuation. But then we need to understand who invested, by which terms, etc., etc., etc. And for us, it's important that if somebody invested in our startup with this valuation, it doesn't mean that we really have this valuation and that we can attract the second investment round with higher valuation. Because, for example, maybe the first kind of seed investor was our friend or I don't know, our relative, etc., who invest in us but not in business idea. It is one story. The second story, it could be that, for example, last year you can raise round with huge valuation in AI startup. This year it is much more difficult because currently this sphere is more regulated and it is harder to attract round. And you need to understand. So, okay, it is always very bad if your second round has lower valuation than the first one. But sometimes, if you understand that first round you was overvalued, and currently you cannot close the second investment round with higher valuation, maybe you need to accept to go with lower valuation. Yes, your initial investor will be disappointed. Yes, your reputation would be failed, but you still can save your business. You need to have the clear plan how you can back to your previous valuation and then to grow. But sometimes you need to accept that your valuation isn't reality. The market size. Market size is also crucial metrics for your scale because you need to understand where you are going and what is your potential. It is also very important when you're selling your idea. Nobody wants to invest in ideas that has tiny market. If you will make something for, I don't know, Albanian market, it will be kind of hard to find investor. Nobody wants to work in a company who is kind of working only on local market. You will not find the rockstar IT guy if you're making something for Luxembourg only. That's why always you're telling that we are global, our goal is to become global, etc. And it is okay. But when you're telling about going global, you need to understand that if something works on your local market, it doesn't mean that you can easily scale it globally. First of all, there are a lot of regulations. And for example, if you are in fintech sphere, something that works in Europe will not work in Asia. Second, there are a lot of cultural change. So if something is okay for USA, it will not work for, I don't know, Australia. Second, there are economic situation. So if something is okay to sell by €5 in Latvia, you will not be able to sell €5 in Africa. So that's why there are a lot of factors that can limit your market. Therefore, there are some some kind of framework you can read afterwards about it. This is kind of great opportunity, great tool how to assess your real market, because in the end of the day, you need to understand the size of the market, a number of people or number of businesses, if you're a B2B product, to whom you can sell your product. And then when you're calculating your model, just take 5% from this market and see what would be your model. Will be you still profitable? Can you still become unicorn, etc.? Because it is really a rare case when some startups can reach more than 5% of market share. Yes, Facebook, Amazon, I don't know, Uber, they did, but usually 99.9%, even more, they reached less than 5% of the market share. And it is good exercise before pitching to investors, because many investors ask it to test if your idea can become unicorn if you reach only 5% of the market share. If yes, then keep going. The growth rate. The growth rate also is kind of tricky question, tricky metric, and really important metric, because the growth rate shows your pace and how fast you can reach your market. And there is one important thing. The growth, it is easy to grow when you are small. For example, you can say that I grew by 300%, but in reality, it could mean that last year you had 2 clients and this year 8. Yeah, it is 300%, but on the another side, it is only 6 new clients. And when you will have 200 clients to grow 300%, it means that you need to find 600 new clients, and it is much time harder than to find 6 new clients. I had one client who made a projection based on his previous growth rate, and by his projection, in 5 years, he wants to reach the sales volume of 20 trillion. It is around world GDP. No, not world, but USA plus European GDP. So, I mean, huge amount. And he kind of didn't see any problem in that. He said that, yes, I just extrapolated my growth rate, so it is possible. Unfortunately, no, because usually when you will become bigger, your growth pace will become slower in terms of percentage. And also, you need to understand that each new clients usually cost more expensive for you, because when you launch new market, a lot of people just know it because of word of mouth. A lot of people just waited for your service, and basically they're kind of free clients for you. But when you're growing, when you are taking new clients and you are expanding your market share, each new client will be more expensive for you. So that's why higher growth rate in the long term means higher investment in your customer acquisition. Margin. So the margin is a crucial metric to understand, do we need to scale startup or to scale our idea or not? Because there are many startups who scaled EBITDA negative product. I believe even each startup, they started to scale the business when they had negative EBITDA, and it is okay. But your gross profit margin should be positive before scaling. It is really huge red flag if your gross profit margin is negative. What is gross profit margin? Gross profit margin is ratio of your gross profit to your revenue. It means that your gross profit should be positive. Gross profit, it is difference between your revenue, between your sales and your self costs. So in simple words, your self cost should be always lower than your price of the product. So that's why the first kind of reason, the first feature when you're thinking, should I scale my business or not, is your gross margin, gross profit margin. And when you're counting your gross profit margin, please take into account all the components that are included in your cost. Because usually, especially when you're small, you don't count many of the costs. You don't count your impact as business owner because you don't pay salary to yourself and you think that everyone will work in the same way. No. So when you trying to count all the costs, you need to really take into account that yes, there should be salary for CEO. Yes, nobody will give some service for free to me, etc., etc., etc. And also, again, when you will growing, each new client will become more expensive to you. And the last but not least, it is about some imaginary rewards. So because usually in different pitch decks, you can see, oh, we are in, I don't know, top 100 of Apple Store in Albania or something like that, etc. But in reality, you need to understand how it affects our business plan, how it affects our cash flow. If this can really attract new clients to us, or I don't know, decrease cost to us, or increase valuation, or something like that, this is okay, and we can be proud of it. If not, yes, we can show it. Yes, we can put this logo of Forbes to our webpage, etc. But to ourselves, we need to understand this doesn't mean nothing because we need to kind of struggle for rewards that affect our cash flow. Okay, so and what I just told you about main metrics that kind of you need to know for a business to make the future decision to scale or to not, to kind of work in this business or to not, how to sell this business. What else metrics should you track to grow your business? First metrics are group of metrics is unit economics. Basically, there are around 50 metrics, and each second there become new and new and new metrics in this field because especially when you're working B2C segment, you need to kind of see on each transaction and see the economic of each transaction. You need to see the payback of each client, etc. Because we are kind of in a really competitive environment, and this is crucial to us to understand, okay, what are the real cost of our new client, what are the real lifetime value of our new client. And in order to kind of at least high level understand the unit economics, you need to know those metrics. First, it is ARPU, it is your average revenue per user. It is really easy to calculate. You need to know your total revenue, you need to know your total number of users, and basically that it. Yes, you can go deeper and to understand, okay, because revenue came to me earlier, user some churn, etc. But let's start from this simple metric. The second one is LTV. This is a really crucial metric, especially if you're fundraising, because each smart investor will ask you about your LTV. Doesn't matter, are you working in B2C or B2B segment? Your LTV, it is your lifetime value of your customer. It means how much you will earn from your customer during his lifetime. And cost of acquisition is the cost of your customer. Basically, when we are speaking about, I don't know, production, it is really easy to calculate self-cost or cost of goods sold. For example, you produce, I don't know, glasses. So you can count the cost of it and you can see, okay, I have this cost from factory and I know what are my costs. But when you are selling marketing consultation, it is really hard to count it. So that's why, or for example, you are selling, I don't know, not even marketing, you're selling some service, like software as a service. So your kind of self costs are your cost of acquisition for the client. So that's why you need to understand, okay, what are those costs? Because when we are counting our gross profit margin, and this is crucial metric to understand should we scale business or not, we need to know our costs. So that's why we need to include cost acquisition here. And cost acquisition includes everything, each marketing activity divided by number of new customer acquired. So basically, it is kind of what are the costs to acquire one customer. And then we can play with those metrics. We need to know LTV or cost acquisition ratio. It means how much times our LTV is bigger than our cost acquisition. So of course, if it is as big, it is as good for us. So, but the minimum is 3. It is kind of in average industry standard, but there are so many exceptions. So if your business has less than 3, don't rush and don't think that you need to close your business, because there are several exceptions. Customer payback period. It means how fast you will start earn from this customer, how fast your profit from customer will be higher than cumulative cost to attract this customer. Customer retention rate is uh, kind of the number of new customers that are staying with you. So it is because we need to understand how many customers we are losing each month, especially if we have kind of recurring payment policy in our company. So the customer retention rate shows us how big portion of customers are staying with us. And this affect directly to LTV. So because if customer stays with us 1 year instead of 3 months, it means that we will earn 4 times more. But our profit will be even not 4 times, but maybe 10 times more, because we don't need to spend more marketing, more money on marketing to stay with this customer. If you go kind of on a level high, so if our business works good in unit economics, so with kind of each customer, with each product, so then we can go on a level high and think, okay, how it business work in general. And here we need to consider always debt to equity ratio. We need to consider current ratio and interest coverage ratio if you have any debts. Even if you think that you don't have any debts, it isn't true, because each salary is counted as short-term debt. Because, for example, today is March 6th, and you will pay salary only in April. So today you kind of owned to your employees for 6 days that they worked in March. And there are the same payments to your suppliers, etc. Also, there are on another side, there are kind of account receivables from your clients, etc. And if you have any debts, serious debts, and if you have responsible person for finance in your company, you can call him just after our webinar and ask, what is our current ratio? And he needs to know. If he doesn't know, then there is huge risk for your company, because basically when you don't track your debt to equity or current ratio, it is the main reason why you can go bankruptcy. And I believe the most beautiful part when we have all the metrics to count our profit, to count the profitability of the metrics. So gross profit margin. So as I have told, I believe 3 times during this short webinar, is is the crucial metrics, because currently we are living in this environment, business environment, where a lot of business who have around 1 trillion valuation, but they have negative EBITDA. For example, Uber, for example, I believe Meta last year also reported negative EBITDA, etc. So that's why EBITDA is good, but let's focus on gross profit, because when you are growing, you most probably will have negative EBITDA, because it's better to invest all your retained earnings to reaching the new market share. So that's why gross profit margin is crucial metrics on the stage when you are growing. Return on equity, it is kind of more conservative metrics, and it is metrics that you are selling to the investor. When investor goes to you, he asks, what would be my return on equity? It means that he invests 100 euro and he asks what I will receive in 1 year or in 5 years on exit. And it depends. In startup, I believe investors are waiting more than 30, I believe, for 5-year period, but maybe they can find less return. Depends on the stage, of course. And internal rate of return, the formula looks tricky, but basically it is, in simple word, it ROI with time factor, because there are 2 different stories. If you receive 200% in 1 year, or if you receive 200% in 5 years. So the ERR kind of, it includes itself not only your return, but return over time. And so basically it is okay for startups that ERR would be around 40-50%. For more conservative businesses, for example, for real estate, it's from 12 to 30%. Sometimes I have met really good ideas, great ideas with strong potential, and the ARR was around 70%. And they asked me to kind of make model more conservative, because when you show huge MRR, the investor can think that you are scam. So that's why also kind of um, be kind of honest with your IRR. And when you have all those metrics, it is important not only to track it once, but to track it over the time. So you need to understand, okay, for example, we can see on the cost acquisition and lifetime value, we can see, okay, this is our kind of MRR. So at one point we reached break-even, and then we started to earn. The same with our retention rate. So okay, we have attracted to 100 clients. So next month we have only 60. Next month we have only 40, etc. So we need to always track all the metrics over the time to see the dynamics. Because when you see, okay, my current ratio is 3, it cannot say a lot of information about you. But when you see that my current ratio is 3, but last month it was 5, you already can, okay, then it means that I have more debt this month. Yep. So I tried to tell as much as I could during these 30 minutes. So if you want to have more information, we are launching our course for finance. So you can scan the QR code and register on it. I hope it will be soon in Q2 of 2025. And yep, stay connected with us. You can book 20-minute free personal consultation. I would be more than happy to help any of you so in a private consultation. And if you have any questions, so please write it into the chat. I will try to open it now and see if we have ones. Okay, so Andres ask, could you recommend any working strategy for decreasing churn rate? So if you want to decrease the churn rate, you need to invest in the retention. First of all, so I don't know your product, but we, for example, this is a real case. We had at the platform, it is one of John Goldfein's client. And so we have calculated that invest to retention. I mean, for example, I will try to explain. To increase retention by 5% is more important for business than to increase growth rate by 5%. So that's why we focused on retention. And what they do, they just hired 2 people who are responsible for the content for the current client, and they provided a lot of free content for the current client just to increase his retention, just to increase more loyal client. I had another case with fintech platform. They kind of also had a lot of problems, etc. And they had a lot of monthly active clients. And what we do, we provided to those clients annual subscription with huge discount. And they, first of all, we have received a lot of free cash without any investing rounds, without any debts and interest rate. Second, we have received a lot of loyal clients, and kind of our churn rate decreased dramatically because clients already paid for 12 months in a row. So that's why it became better for the business. I really hope that you scanned QR code. So, and I hope to talk with each of you privately, and I really hope to provide some kind of valuable feedback about your business. And thank you for attention. I really hope that after counting the metrics, we will count our dividends. Thank you all.